At Berkshire Hathaway, we have all kinds of businesses. We own 73 businesses now, and in businesses, we're looking for an entity that has durable competitive advantage.
Investing in companies with an economic moat is one of the most critical elements of successful long-term investing, according to the greatest investor of all time, Warren Buffett. So with help from some Warren Buffett clips, in today's video, I'm going to be explaining what an economic moat is, what are some of the key types of economic moats that businesses have, how you can identify them, and I'll be sprinkling examples with real-life companies all the way through today's video. If you enjoyed today's video, all I ask is that you hit that like button and hit subscribe if you want to stay up to date with content that I post in the future. But with that said, let's jump into the video.
What are the key indicators you look for within companies before making an investment?
Well, I look for something that does give them a moat around it.
An economic moat is simply a competitive advantage that a company has over other businesses. The analogy Buffett uses is a castle with a wide moat of water around it, the castle being a business that produces a lot of profit, and naturally when businesses produce a lot of profit, there will be other businesses that enter that market or enter that industry and want to steal customers away from it, get a piece of that economic pie. And businesses with a wide moat around them are much more likely to have sustained and even growing profits over time.
In capitalism, when you have a wonderful business, it's like having an economic castle. The nature of capitalism is that people want to come in and take your castle. Now, what you need is a castle that has some durable competitive advantage, some castle that has a moat around it.
What this ultimately means is a business that has an economic moat is one that sells a product or a service or has some attribute that compels customers to come back to that business regardless of other competition selling similar products and services. But why do we need to invest in companies that have a deep economic moat? Well, the economy is messy and individual businesses, almost all businesses, will go through numerous problems over time. And some of these problems stem from the broader economy, such as a recession going on and an overall decline in the level of spending from consumers, or it could be a problem that happens specifically within the business, such as the poor performance of a new product launch resulting in lower revenues than were expected during that year. And when these events happen, investors flee these stocks. They sell these stocks, causing their stock prices to go down. And the reason for that is because the higher level of uncertainty created by the problem creates a fear that the business won't recover back to where it was previously. And the truth is that a lot of the time, businesses that go through a problem do not recover to where they were previously. They might go out of business completely, or they might just never get back to where they were. So that is exactly why we need to invest in companies that have a deep economic moat, because businesses that have a deep competitive advantage, something that is compelling customers to come back, those businesses we can be confident will return to where they were previously after the short-term problem has gone away. And this ultimately means that when a stock price of a great company is collapsing and everyone is fleeing that stock because of the uncertainty around it in the short term, we can confidently invest a significant amount of money, and that ultimately will be the best time to invest in a great company, when its stock price is down and it's undervalued by the market. So let's talk about some of the different types of economic moats, because there are many different ways that a business can have a competitive advantage, can develop some kind of intrinsic layer of protection around their business. The first type of moat is a switching cost moat, and this is where it is very expensive or irritating or frustrating for a customer or for a business who is a customer to switch from that product to a competing product, so they end up staying even as that business, say, consistently increases their prices. Apple is probably one of the best examples of this. They have built this ecosystem of products that work really well together, and if you have a mix of Apple products and non-Apple products, such as a computer and a phone or a smartwatch, they just don't work as well together. So if you have a bunch of Apple products, it's far more likely that you're going to want to add to your basket of Apple products when you get a tablet or get a smartwatch or whatever it is that you're adding to the devices that you own. Another really good example that I often use is Adobe, who not only serve individuals but serve a lot of businesses. And when businesses have maybe hundreds or even thousands of employees who are trained to use Adobe software, if the business is to switch to a different creative software, they have to retrain all of those employees, and that's going to take a lot of time. And even after training them, there will be an efficiency gap. They won't be as good at using that new software as the old one. So there's a significant cost to businesses in particular when it comes to switching out from something like Adobe. The next economic moat is a networking effect. This is where a service gets better as more users are using the service, and as a result of more users using the service, it gets better and attracts new users, and it's this flywheel positive feedback loop, which ultimately, in a lot of cases, ends in a monopoly for a particular product or service. And I think the best example of a networking effect is YouTube. YouTube has the most eyeballs on it in terms of video content online. So as a result, creators are going to want to post on YouTube and not on other video sharing applications. And because more creators are willing to post on the platform, there is more content, which makes the platform more attractive to more users. And over time, this has meant that YouTube has developed a monopoly. Creators like myself are not going to take the time to post video on a different platform that is similar to YouTube but has less of an audience, and you're unlikely to go and try and watch videos or get recommended videos on a different platform that has far less content and far worse content as well. Another economic moat is economies of scale, and this is essentially where the cost per unit for a business to produce a product, for example, goes down as they increase the volume that they're selling. And this kind of works for both types of costs, both fixed and variable costs. So fixed costs go down because you could imagine a business might own a factory, and there's some expenses that are relatively fixed for that factory: electricity, leasing it, maybe the cost of buying it or repairing it. All of these things are relatively fixed regardless of how much volume is going through that factory. So if they can increase their volume, those costs will be spread out more evenly across each unit. And also for variable costs, for the cost of material, for example, when a business is able to buy materials to produce things in higher quantity, they're generally able to do it at a lower cost. I think Walmart is one of the best examples of a business that demonstrates economies of scale. They are the largest general merchandise retailer in the entire world, and that means that they're able to produce products at a relatively low cost. They're able to source products at a relatively low cost and pass a lot of that cost saving onto the customer. And that, in combination with some internal efficiencies, some systems that Walmart has developed over time, means that they have very, very low products compared to most competition. And they also have decent profit margins, meaning they can retain some of that incremental value and return it to shareholders. But by far the most interesting type of competitive advantage, or economic moat, to me at least, is scale economies shared. And this is where we take the economies of scale that Walmart uses, and instead of retaining that incremental economic benefit mostly for the shareholders, you mostly or entirely deliver it back to the customer, either in the form of lower prices or in a better customer experience, or a combination of both. And this might seem counterintuitive because the business is likely going to have worse profit margins than other businesses that it competes against, and that might make it seem as though it's a worse business, that it doesn't produce as much profit for shareholders. But a business that is willing to sacrifice profit today in order to attract and retain a lot of customers over the long term, for having a strong reputation of maybe its low prices or a really high quality experience or product, those businesses will ultimately, over the long term, beat every competitor. Amazon is a great example of a business that has demonstrated this over the past couple of decades. The business for a very long time has been viewed from the outside as a very poor profit margin business, hasn't produced a lot of profit for, especially in the early years of Amazon. But a big part of the reason why that was the case is because Amazon had an aggressive, and still does, an aggressive focus on lowering prices of their products consistently. And not only that, but also improving the experience, meaning reducing the cost and the speed of delivery for as many people as possible. And all of this has meant that Amazon has essentially won digital general merchandising. They're the biggest. They will likely be the biggest for as long as they continue to use these competitive advantages to their benefit, and they are an amazing business. Great example of scale economies shared, where they achieve economies of scale but deliver it back to the customer in the form of either lower prices or a better experience. And there's many other economic moats that I could talk about, but this video would go on forever. Some of these include intangible assets such as patents or a brand advantage. A toll moat is also there, high barrier to entry, cost advantage is another one, and a natural monopoly. These are some of the others. If you want to go check them out, there's a ton of information online about all of these types of economic moats. But that list of about, how many did I give? About 7 or 8 or 9 economic moats is a good place to start when trying to figure out what moat a business might have. But how do you know for sure? It's really, of course, not enough just to look at a business and go down the list of economic moats and think maybe they have that one. How do we know that they do? Well, a really good starting place is to think about just logically what a business would look like if it did have something that compelled customers to come back consistently. Ultimately, that business would have extremely consistent and probably high growth, higher than its competition, over time, over the very long term. So for me, that means we're looking at consistently high revenue growth, earnings per share growth, equity or book value growth, and then also cash flow for owners growth. So making sure that they're not only growing their profits on the income statement, but also on a cash basis. And checking out the growth of these areas over time for a business is super easy if you use my free stock analysis spreadsheet. It's linked down in the description below. You can download it. It's super easy. There's also a walkthrough and tutorial linked down in the description below of how to enter in all of the data and how to use it. But once you've entered the raw data into the data input tab, click over to the growth tab, and you'll see a table that shows you the 4 key areas: earnings per share, revenue, equity, and cash flow for owners, and their compounded growth over either a 1, 3, 5, 7, or 9-year average. So for example, the 9-year column is the per year compounded growth over the past decade. And we're looking for 3 things: consistent growth, growth that's above 10% per year over the long term, and in best cases, accelerated growth over time, meaning the 1 and 3 year growth rates are higher than the 7 and 9 year growth rates. Of course, there's limitations to just looking at those 4 key numbers. It's certainly not enough just to do that. And that's because there are businesses that are able to grow even for a 10-year period in some cases at a high rate across the board in those areas without an economic moat. Some of the key ways they can do this is through acquisitions. So businesses might have terrible businesses, but if they keep taking on debt or using equity and buying other businesses and just adding another business on top, all of the businesses they own might be terrible, losing customers, but their business will be growing because they're just adding another business on top, and that of course will increase revenue and profits over time. Or the business may just be a small business in a really fast growing industry. This is something you have to be careful of when you're looking at micro cap companies or businesses that have a market cap below 500 million, is a lot of these businesses might be tiny fish in a fast growing industry, and as a result they're easily able to grow at high growth, but that doesn't necessarily mean that they have a strong enough competitive advantage to compete at the larger scale as they get towards the billion-dollar size and even higher than that. Ultimately, your ability to figure out if a business does have a powerful enough competitive advantage or an economic moat is going to come down to your understanding of the industry and your ability to identify the key business indicators which show us that the business has a wide economic moat. So just to give you some examples, if it's a subscription-based business, then some of the things you're going to want to look at are how strong is their retention rate, so how many people are staying on the platform month over month or year over year. And then also, what is the engagement on the platform? How much time are people spending using a certain platform compared to competing platforms? And for businesses with physical stores, you're going to want to focus on the increase in traffic at those stores over time, because that's a direct indication of how many customers are coming through the door and whether that number is going up, is stable, or going down over time. So starting with the key types of economic moats, you can start to figure out what the advantage might be. You can then enter the data into the spreadsheet and start to look at how the business is growing over time. But ultimately, you'll want to read through the annual report for the company, figure out what are the key drivers for the business, some of the examples that I just gave just then for different types of businesses, and use those to also go even deeper and figure out really how this business is competing against others and whether it stands above. Is it in its own category away from everything else, or is it just another business with a similar product and service that other businesses can easily replicate? But that's all for today's video. Let me know if you enjoyed this one. But with that said, hope you guys have a great week, and I'll see you in the next video.